All right. In this video, I'm going to do an interesting comparison. I'm going to look at Amazon versus Costco and answer which one I think is the better stock to buy. Of course, Amazon is the online retail giant with the cloud services business, and Costco is the best-in-class brick-and-mortar retailer. And we're going to look at these two and see the interesting differences in terms of their revenue, their profit margin, their return on invested capital, and their valuation. We're going to see several surprising distinctions between these two businesses here in this video. So let's get started with revenue. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so when measuring on revenue, Amazon is more than twice the size of Costco, the second largest total revenue business in the world behind Walmart. Amazon at $590 billion in trailing 12-month revenue versus Costco at $253 billion in trailing 12-month revenue. Costco has grown revenue nicely over the previous decade, but nowhere near the rate of Amazon over the previous decade. For a brick-and-mortar retailer, Costco is one of the best in terms of revenue growth over the previous decade. I think Home Depot is another one that matches Costco in terms of brick-and-mortar retailers, primarily brick-and-mortar retailers that deliver close to 10% revenue growth annually over a long period of time. So there are not too many brick-and-mortar retailers that can generate that kind of revenue growth in the previous decade because the backdrop of people spending more money online. It's just so much more convenient to shop online than it is to go in person and shop. Now, Costco delivers great deals to many folks in its warehouses. People pay an annual membership fee for the privilege to shop at Costco warehouses. But if you've ever been inside of a Costco, at least the ones that are near me, it's a huge inconvenience. Lines are long. The place is crowded. It's never empty. You could go on a Sunday afternoon or a Wednesday evening. The Costco is full to the brim. You cannot stop. As soon as you stop, somebody hits you from behind with the shopping cart because there's no room to maneuver. Those stores are full. Compare that to shopping at the convenience of your home on Amazon.com, looking for the things you want, and Amazon brings it to your doorstep. What's even more convenient, I can subscribe to all of my items that I need regularly on Amazon, and they'll deliver it regularly. I don't even need to think about it again. Every 2 weeks, they deliver the things that I need, the things that I want, and I get a discount for subscribing instead of going on and on to continue my shopping. So interesting differences here between Costco and Amazon. Now, Amazon has been able to deliver increasing operating profit margins, economies at scale. Costco, meanwhile, has not done that, and that's on purpose. Costco favors passing lower prices to customers. They don't want to use their increasing scale to generate greater profit margins. They want to use their increasing scale to offer better prices to customers. That's their secret sauce. That's what's kept them on top of consumer minds. That's what's kept consumers going back to Costco stores. I highlighted earlier that the stores are always full Wednesday evening or Sunday afternoon. That's how Costco does it. Always offering good deals that attracts people into their brick and mortar stores. They also offer variety. Different seasons has different items, different years have different products. And so you never know what you're going to see when you go to Costco for your weekly or monthly shopping trip. That's what they've provided tremendous success on. This strategy that Costco implements is the most difficult strategy in business to execute. The low cost, high volume strategy. They offer you low prices, lowest prices possible, and they want you to shop more and more and more. They want to sell more and more and more items. It's a very difficult strategy to execute because there's a lot of moving parts. You've got to have your buyers doing an excellent job finding the products your customers are going to want, putting them on the shelves in the right places in the right quantity at the right time, working with your suppliers, your logistics, your shippers, all of which has to come together consistently over a very long period of time in order to maintain profitability using this business model. Not very many businesses have been successful with this business model, but those that have can maintain a successful competitive advantage because you're not going to get very many challengers coming to take your market share if you're generating an operating profit margin of 3%. That's not going to get anybody excited. That's not going to get anybody interested in spending billions of dollars to come compete with you for a 3.5% operating profit margin, which is where Costco has been. Amazon, meanwhile, has scaled up and it's benefiting from those large capital investments in its logistics and fulfillment business. That's what drives growing profitability for Amazon is as the network grows, the cost per delivery decreases because Amazon adds more and more warehouses closer and closer to customers. That decreases the distance the products have to travel, lowering the cost per unit for delivery and driving better profitability and increasing speed for customers, which makes it more attractive to shop at Amazon. And so you've seen very nice, consistent increasing operating profit margin at Amazon at 8%. And I didn't even mention the Amazon Web Services segment because I'm comparing to Costco on a kind of retail sales type business. Amazon's Web Services segment has absolutely thrived as well, generating 30% operating profit margins. That part of the business is more profitable than the retail segment, which generates operating profit margins closer to that of Costco. If Amazon didn't have those more profitable segments, including AWS and advertising, its operating profit margin would likely be closer to that of Costco. Similar story when we look at cash flow from operations to sales. Costco at a very low level, 4.77%, and Amazon at 16.78%. Amazon using its economies and scale to generate better cash flow for investors. Costco using its economies of scale to deliver better deals for customers, a different strategy. Now, those different strategies have played different roles. One of the more surprising numbers to look at is the return on invested capital, where Costco leads Amazon in this metric, 23.74% most recently, compared to 15.3% for Amazon. I highlighted earlier that when you go to a Costco locations, it's full Wednesday evening or Sunday afternoon. Now, some businesses, when they see that kind of capacity inside of a store, they'll open a new store because they'll see that customer demand is really strong, right? They'll open a new location, not right next door, but somewhere around the area, not Costco. They want to absolutely maximize each location. They want to really get it jam-packed all the time, all day long. They want customers to come in and use that same store as much as possible. That way, Costco can generate more cash from each store and drive better deals for customers. So they've so far been successful with that strategy, and it drives strong return on invested capital because they're not investing that much capital per dollar of sales as a usual brick and mortar location would, because each location is generating such strong sales and profitability. Now, they also do that by not emphasizing their online business. They do have an online business, but they don't emphasize that. You get better deals when you go in person, right? If you shop online, there's usually a higher price. And so it really encourages people to go into their locations and drive more revenue per location. So they've done a great job in this. In fact, they've, over the last decade, for the most part, save for a couple of brief moments during the pandemic, otherwise Costco has exceeded Amazon in terms of return on invested capital. Finally, I wanted to compare these two on valuation, and it's no secret Costco is an excellent business. It's no secret to hardly any investor, and you can tell that by its valuation. Costco is trading at a forward price to earnings of 49. That's more than 50% as expensive as Amazon, which is trading at a forward PE of 32. So you have a physical brick and mortar business with operating profit margins less than 4%, trading at a premium valuation against Amazon. And Costco trades at a premium valuation against a lot of businesses. And, while I have admitted that Costco has been an excellent business, the stock price has been expensive for a long time. They've executed to near perfection over the last decade and more. And I've been hesitant with Costco stock because of the valuation. So I guess you can understand where I'm leading to here. If I had to pick between these two stocks, I'm picking Amazon because of the better valuation compared to Costco. And, some of the metrics, in most of the metrics, Amazon was better than Costco, except for the return on invested capital. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.